When you're analyzing a piece of commercial real estate, it's really easy just to look at the big picture items like the IRR, the equity multiple, and the cash on cash of a deal, but these are not the only things that you should be focused on as a commercial real estate investor. And by looking at a few other key metrics, you can get a much clearer sense of how your business plan is projected to impact a deal and the effect that leverage might have on your investment, which can also help you make more well-informed decisions about the actions you plan to take to create value and how you plan to capitalize a real estate deal. So in this video, I want to zoom in on 3 metrics that a lot of newer investors miss or don't pay as much attention to as they should when analyzing commercial real estate deals and what each of these things can tell you within a real estate investment analysis. So the first metric that I want to highlight here is one that's very commonly overshadowed by the going in cap rate on a deal, and this is the stabilized yield on cost. A lot of commercial real estate business plans include some sort of a value add component where the investor plans to either renovate multifamily units and raise rents as a result, or lease up vacant commercial suites to increase revenue and ultimately NOI, meaning that the net operating income at the time the property is acquired isn't always indicative of how that property is projected to perform once the deal changes hands. And while the going in cap rate just measures the first year of projected net operating income divided by the purchase price of the property, the yield on cost of an acquisition provides a more forward-looking view of a property's stabilized net operating income yield as a percentage of the total cost of the project, including any sort of renovations or commercial leasing costs that are going to be incurred to increase that NOI. This can give you a much better sense of what you'll actually be spending to get a property where you want it to be operationally and to determine if those costs are worth the incremental cash flow and value that you plan to create as a result of these changes. And to use an example here, if we were to buy a property with a projected going in net operating income of $1 million and we paid $20 million to acquire the deal, that going in cap rate would be 5%. However, even though this 5% value represents a going in unlevered yield based on current operations, if we plan to improve the property in any way, the stabilized yield on the investment might end up looking substantially different. So in this case, if in addition to our $20 million purchase price, closing costs were assumed to be $100,000, planned common area renovation costs were assumed to be $1 million, and leasing commissions and TI allowances necessary to lease up vacant space were expected to be another $500,000 on the deal, this would bring our total cost on the acquisition to $21.6 million. But if those common area renovations would allow us to generate higher rents during that releasing process, and within a year after our releasing was complete, we were now generating $1.5 million in NOI, this materially changes that unlevered NOI yield with a stabilized yield on cost of almost 6.9% in this case, or almost 200 basis points higher than that initial going in cap rate. This is why, while cap rates can be helpful to get a general sense of where properties are trading in a market, these aren't the end-all be-all when it comes to pricing on a deal, and taking a look at the projected yield on cost is going to give you a much better idea of how that unlevered yield compares to other investment opportunities in the market with comparable costs and risks. Now, the next metric I want to zoom in on can have a significant impact on the cash flow an investor can generate, and with that can even impact how much leverage an investor chooses to use on a given deal, and this is the loan constant. The loan constant just measures the total annual debt service payments as a percentage of the total loan amount, which is going to be different than the nominal interest rate on the loan, since this will incorporate both interest and principal payments that need to be made on an annual basis. So while you might look at a deal that's being purchased at a 7% cap rate and financed with a loan at 6% interest and think the loan is going to have a positive impact on your cash flows, this is often actually not the case and doesn't tell the whole story from a cash on cash perspective. And again, to apply this concept to a sample scenario, assuming an amortization period of 25 years is used to calculate monthly payments on a loan, which is relatively common for commercial real estate deals, that same loan with a 6% interest rate will have a loan constant of 7.73%, which is materially higher than that 7% cap rate. And if we assume that this property is being acquired for $10 million, this would make our going in NOI at that 7% cap rate $700,000, producing a 7% cash on cash return on the investment before factoring in debt. However, if we do assume to finance the property at a 60% LTV ratio, this would reduce that initial equity investment required to just $4 million on the deal, but would also add more than $463,000 of debt service that needs to be paid each year. And if we subtract this $463,000 amount from our initial $700,000 NOI, this results in just $236,000 in cash flow left over, which, based on that $4 million equity investment, would produce a cash on cash return in our leverage scenario of just 5.9%, or 110 basis points lower than in the unlevered scenario. And this is important if investors are buying real estate primarily for the cash flow they can generate, since increasing leverage when the loan constant is higher than the cap rate will actually decrease the investor's annual cash flow as a percentage of their equity invested in a deal, with a 70% LTV ratio in this scenario, dropping the cash on cash return to just 5.29%, and an 80% LTV ratio in this scenario, dropping the cash on cash return to just 4.07% on this same deal. The point here is that if your main goal is to maximize your cash flow yield, even if your interest rate is lower than your cap rate, understanding what that loan constant is and if a loan is going to increase or decrease your cash on cash returns is going to be extremely important and needs to be factored in when making financing decisions. Now, the loan constant and the yield on cost are two big factors that are going to impact a property's operations, but the last metric I want to focus on here is related to both operations and the projected sale price of a property, and this is the unlevered internal rate of return. When you see an advertised IRR in a deal, this is almost always going to be expressed on a levered basis or factoring in debt into the cash flows, but many real estate financial models used by some of the biggest real estate investment and development firms in the world will measure not only the levered internal rate of return, but also what the IRR would be if no debt were used to finance the project. This allows investors to very clearly see the impact that a loan is projected to have on investment returns, and in many cases, how much of the IRR is projected to be a direct result of the property's financing structure. Unlike the cash on cash return, even if the loan constant is slightly higher than the going in cap rate, if a deal is assumed to be sold at a profit, incorporating debt into the cash flows will increase the IRR of a project in almost all cases. However, just because that IRR might increase as debt levels rise, this doesn't necessarily mean that more debt is better, and taking a look at the difference between the unlevered and the levered IRR on a deal can provide a lot of context around how much risk is being taken on to achieve a desired return. For a 5 to 7 year hold period on deals being underwritten to a targeted 12 to about 15% levered IRR at a relatively conservative 55 to 65% LTV ratio, the spread between the levered IRR and the unlevered IRR on a deal is usually going to fall somewhere between about 500 and 700 basis points. However, if you crank up the debt to an LTV ratio of 75% or 80% or even 85% on a deal, which some investors have done in recent years with a combination of senior debt and mezzanine debt to be more competitive on pricing and increase the levered IRR for investors on paper, this spread starts to get significantly wider, which can be a really helpful indicator of increased default risk. This is especially true in the case of short-term hold scenarios where you might underwrite a deal with an unlevered IRR of something like 5%, which on its own is relatively weak, especially if you're taking on a significant amount of risk to get there, but by adding a material amount of leverage to finance the transaction, you might be able to bring that IRR up to something like 20%, 25%, or even higher, which can make the deal look a lot more attractive on paper to potential investors that might partner with you on a deal. And the problem with this is that these levels of debt introduce a significant amount of default risk into a deal, and if interest rates increase and rents and values decrease like we've seen across many product types and markets over the last 18 months, this is where many investors can and often do seriously get into trouble. Now, this obviously isn't an all-encompassing list, but these are 3 things that I've found to be very commonly overlooked by newer investors in the industry, and in my experience working in institutional settings, these tend to be some of the most heavily scrutinized metrics by major investment firms when analyzing risk and making investment decisions. And if you want to learn more about the real estate investment analysis process and the other key metrics that are used to underwrite commercial real estate deals, as always, make sure to check out our all-in-one membership training platform, Breaking into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on the underwriting and analysis process, make sure to hit the like button to let me know, and let me know in the comments any other metrics you look closely at outside of the IRR, the equity multiple, or the cash on cash. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.